Hello, everybody. This is Bennett Tchaikovsky, the accounting professor. Welcome. We're going to start today. If you're just getting brand new learning financial accounting, this is going to be a series of problems that I'm doing using as in-class assignments from my financial accounting course. Hopefully these will go through and help you. These questions are copyright myself. All rights are reserved. If I'm using names entertainingly, those names belong to the people who have them. I'm not claiming to use of those names. And any not retribution, but redistribution is expressly prohibited without the prior written consent of the author. And it goes without saying any opinions or any statements are those of myself and not my employers or any other type of affiliated organizations, including the South Orange County Community College District and Irvine Valley College. So the question we're going to go through today is completely unrealistic, but it has a place in our hearts because what we need to learn how to do is how do we go through and record asset liabilities and owner's equity. And we're going to be recording transactions. We're going to then make a trial balance. And then we're going to finally go through and do a balance sheet. And it's completely unrealistic because all the transactions are taking place on one day or December 31st. And if we didn't do it this way, we wouldn't really, we get into some problems. However, from a learning standpoint, when you're learning accounting, using T accounts is by far the best way to go, because when I go through and I use T accounts, this can essentially go through and help me get the answers that I am going through and seeking. Mainly that when we're starting out the grand equation, it's often times referred to is going to be our assets, which is going to be equal to our liabilities plus our owner's equity. Right? And this is what we call the balance sheet. Meaning that our assets are going to be equal to our liabilities plus our owner's equity. If we were to come over here, and if I were to go and look up a company, we'll go over here to our friends at Apple. When we look at Apple, pull up their quarterly report, one of the first documents we should see besides their income statement is going to be their balance sheet. So what we're learning about today are assets. This is going to be equal to our liabilities plus our owner's equity. And I'm making a little T account, but let's just talk about this really quickly. What is an asset? An asset is something that is going to be giving us future economic benefit. It's something that can be what we own, we have the possession of legally, that we can basically convert into cash or we're going to be using for our business. Examples of assets are cash, marketable securities, meaning that we've taken our cash and we've invested it. Accounts receivable. I've sold something to a third party or to someone, and they have not yet paid me. I performed a service. I've not yet been paid. Inventory. This is something I've bought or I've created, and I'm turning around and reselling it. Other current assets might be if I've prepaid for an insurance policy. Property, plant, and equipment. Property, plant, and equipment is going to be property which I'm going through and using in my business activities. So here we have for Apple total assets of 331,000. No, this is actually in millions. So this is going to be 331 billion. So when we look at assets from an accounting perspective, assets are going to be giving those items that give us future economic benefit. And the way we're going to go through and record assets is we're going to take our balance sheet equation, our assets equals liabilities plus owner's equity. We're going to draw a little T down the middle, right? The little T is going to be separating the assets and the liabilities and owner's equity. And then we're going to write in debit, credit, or DC. What's our nation's capital? where crazy stuff goes on, Washington, D.C. It's a heavy metal band, AC/DC, whatever way you want to go through and remember it, that's fine. But what this tells us is when it comes to recording asset transactions, right? Assets will typically have debit balances. They're going to be increased with debits, and then assets will be decreased with credits. Whenever we have a transaction going on, this always has to be true about assets. Let's look at the other side of the equation. So we've said that assets, or those items that are giving us future economic benefit, are going to be equal to our liabilities. And over here, liabilities, and then we have owner's equity. Now notice, our total assets are 331 billion, 612 million. Our liabilities and equity are 331 billion, 621 million, 612 million, excuse me. Basically, our total assets have to equal our total liabilities plus owner's equity. This is our what we call a balance sheet. What it's really telling us on the other side of the equation is that how are these assets owned? So when I look at this over here, I've got my total assets are 331 billion. How are those assets owned? Right now, a liability. This has to be repaid, right? So over here, we've got accounts payable. Well, we've received goods from somebody maybe to resell, but we have not yet paid them. That's what we call an account payable. Deferred revenue. If I'm Apple, I sell Apple Care, right? And basically, if I sell Apple Care, I have to recognize that revenue over the life of the product, but we call it deferred revenue. Commercial paper and term debt. These are obligations I have to go through and repay. We have other term debt, which is non-current. We'll talk about that at a later episode. And then coming down over here to other non-current liabilities, total liabilities are 264 billion. Now, what does shareholders' equity mean? Well, we see over here, we've got common stock and of 79 billion. They have an accumulated deficit of 4.7 billion, and then another accumulated comprehensive loss. For our intents and purposes right now, just think about this in terms of common stock, right? So we're talking about here common stock. This is what the owners own of the assets, is basically going to be that common stock. So coming right over here, I come back to this over here. So let's talk about liabilities and equity. So if I look over here at the other side of the equation, when it comes to liabilities and owner's equity, these basically here will be liabilities plus owner's equity will be increased with credits, right? Because it's on the right-hand side of the T account. The right-hand side is DC, debit credit, right? And then also liabilities and owner's equity will typically have credit balances, okay? Whereas over here, liabilities plus owner's equity will be decreased with debits, okay? So when we're recording transactions, whatever dollar amount I have of debits, I have to have a corresponding amount of credits. So when we're going through and looking at these different transactions, this is what we kind of have. Just kind of keep this in mind. Every transaction we record, it has to make sense with this. If we're showing an asset being increased with a debit, we also either have to show an asset being decreased, and we'll see in some parts, or it has to be over here. We have to be showing a credit to a liability or an owner's equity account. So we've got over here Trouted Rendon, two players for our local baseball team here in Orange County, California, that have had a pretty rough patch of it as lately, but maybe they'll make it happen. I don't know. I'm not sure if it will, but we can always hope and pray. Let's go over here and look at the first one. Mike and Anthony each contribute $250,000 cash to TRI in exchange for common stock. We're doing this for TRI. That's basic or try. We are trying to make our baseball careers work out, but I'm going to stop with the jokes, right? So Mike and Anthony, we kind of think about this. So we are TRI. Basically, what's happening is Mike is going to be giving us $250,000 cash. Anthony is going to be giving us $250,000 cash, right? So TRI is receiving cash. So over here, the total amount I'm receiving is going to be 500,000. Or letter A, I'm going to debit cash for 500,000. Why am I debiting cash? Well, if I'm TRI and I'm receiving cash, I'm increasing my cash balance. Cash is an asset. It's giving us future economic benefit. I can spend it. I can go do other things with it. But it's a debit. It's going to have a debit balance. So we're going to show that increase to cash with a debit. Very important, right? So now we show the increase to cash with the debit. Now, at the same time, what is TRI really going over here and doing? Well, to Mike, they're giving common stock. And to Anthony, TRI is giving basically, they're giving common stock to Anthony. And that's what TRI is giving back to them in exchange for the money. So in this case over here, I'm issuing common stock. What type of account is common stock? As we kind of saw over here from Apple, common stock is an example of an owner's equity or shareholder's equity, right? So if I come over here, liabilities plus owner's equity, I'm increasing the amount of shares that are outstanding. So I'm going to basically show this over here as a credit. So when you look at these transactions at the end of the day, right? If I'm receiving cash and I'm giving up common stock, the way we record it is always going to be the same. I'm debiting cash and I am crediting common stock. I show an increase to an asset with a debit. For common stock, I'm showing an increase to owner's equity with a credit. Now, for those of you who are more advanced and you're just coming upon this video, you might be saying, Bennett, what about common stock at par? And what about additional paid-in capital common stock? Are Mike and Anthony accredited investors? Well, that one's like a legal question, but the additional paid-in capital common stock and common stock at par, those will be things we'll be looking at when we get over to owner's equity, when we look at that chapter. But for now, we're concerned with you when we're starting accounting is how do we go through and record and summarize very basic transactions. So there we go. That's letter A. Let's take a look at letter B. Albert contributes equipment valued at, maybe it's a treadmill, at $150,000 to TRI in exchange for common stock. Now, this is also something that's important. Not only can you contribute cash, you can also give equipment, right? So many businesses, when they're started, if you've started making some intellectual property, you might contribute a patent or something else like that. But don't worry about that for right now. So I'm TRI. What's happening with TRI is I have Albert, right? So Albert is giving TRI basically over here is giving equipment. Oh, it doesn't like this one. Oh, I know why. I put an equal sign without doing my fun stuff. So Albert's giving equipment now. What type of account is equipment? Well, equipment is over here. Property, plant, and equipment. It's something we're using in our operations, right? So maybe it's going to be exercise equipment to keep those players nice and healthy. So This is equipment. Equipment is an asset. It's giving us future economic benefit because we're using it in our operations. So over here, I'm going to debit equipment for $150,000, right? Okay, so I'm debiting equipment. Equipment is an asset. I'm showing an increase of that asset with a debit. Now, for every debit, I need a credit. What's the other side of the transaction? Well, over here, what is TRI giving up? Well, they're giving up common stock. And over here, well, how do we record a common stock transaction? Well, we just went through and did it. It's exciting. We're going to go over here and credit common stock for $150,000. That's how we're going to go through and record that transaction. So in addition to cash, you can also accept other things for stock, right? There's some perils to doing that. You might want to hire an appraiser, but again, we're looking at things on a very, very, very basic level. That's all we're doing right now. Let's go ahead and take a look at this next one. Monkey Rallied. Those don't really come out very much anymore. Monkey Rallied Inc. or MRI. Appropriate name. Gives $59,000 to TRI for future services that TRI will perform in early 2027. So this is a balance sheet on December 31st, 2026. We're going to be doing this on 2027. So let's think about this. MRI is giving us cash. Okay, so to Trout Rendon Inc., they are giving us cash. Okay. So they're giving us $59,000 cash. If I'm doing this for TRI and I'm receiving cash, how do I go through and record this? Well, I'm going to record this over here with a debit, right? I'm going to debit cash for that $59,000. Now, for every debit, I need a credit, but what am I giving back? I'm not giving back common stock, but rather I'm promising future services. So in this basically is what we're going to call promise to perform future services, that I'm going to have future services to be performed. And this is something we're going to call unearned revenue. Okay. It's a liability, meaning that we've received money for work we have not yet done. And if you kind of think about it, it's kind of like Apple Care, right? We've gotten money to protect our Apple products, but Apple, though, I just got it today and it's going to give me Apple Care for 2 years. So I can't recognize that revenue yet. We call it unearned revenue. You can call it deferred revenue. You're going to find that a lot of these different accounts have different names, but I'm more concerned that it's an obligation of the company or it's going to be a liability. How do we show an increase to our liabilities? We got the cash, but our liabilities are also increasing as well because we have to perform these services in the future. So right over here, unearned revenue, 59,000, transaction C. Remember, cash goes up, show an increase to my assets with a debit. I have a corresponding credit for the amount of the unearned revenue. Let's go to the next one. TRI borrows $175,000 from Silicon Valley Bank. There might be a KPMG partner that's getting upset with me, but this is a bank that's been purchased by somebody else, or SVB. The loan will be payable by TRI on 12/31/28. Now, you might be saying something to me, Bennett, hey, dude, like, where's the interest? Where's all this other stuff? We're not going to be concerned about that yet. Remember, what I'm more concerned with right now is that you know how to record assets, liabilities, and equity. And that's all we're doing in this exercise. It's fun. So if I'm borrowing money from Silicon Valley Bank, that means I'm receiving cash. So let's kind of look at this over here. So Silicon Valley Bank is giving us cash. Or up here, it is 175,000. Now, are they giving this money to me for free? Well, we're getting 175 grand. So I'm receiving cash of 175,000. By the way, if I'm going too slow, I've always been told, Bennett, you're better on 2 times speed on some exercises, maybe 1.5. It's okay. Speed me up, slow me down, whatever you want to do. I won't take offense. So I'm getting $175,000. That's an asset. My cash is going up. But for every debit, I need a credit, right? Is this money free? Well, maybe. No, it's not. I have to repay it. So over here, this is something if I'm borrowing money from someone and it has to be repaid, this is going to be a loan payable, meaning that I have to go through and pay this back. A loan payable is a liability. So over here, I'm going to record that liability with a credit. Okay, now a lot of times people will ask, and we'll talk about this a little bit later, but a loan payable is when I am borrowing money directly. So I borrow money from Silicon Bank, and there we go. All right. TRI loans. So we're giving money to Morenode Signing Inc., MSI. MSI will repay us in a couple of years. So what's happening here? Well, I'm giving money to MSI. So let's take a look at this one over here. So in this one, I'm giving cash in the amount of 76,000 to MSI. So if I'm giving cash, my cash is going down. So over here, my cash is going down. For every credit, I need a debit. What is this? Well, they're going to repay us in the future, right? So basically what this is this is going to be a loan receivable, right? So they're giving us a promise to pay. That is an asset. So over here, we're going to have a loan receivable. It's increasing because they have to pay us in the future. And that's going to be for $76,000. Okay. Now come over here. Letter G. Exciting. We're getting, oh no, we got to go to letter F. We forgot letter F. Oh, holy God, I'm effed. No, I'm just kidding. We're not effed. We're just going through the alphabet. We just skipped one. It's okay. We purchased equipment for $90,000 by paying $25,000 cash and placing the rest on a note payable. The note bears interest at 7% and will be due on 12/31/30. Now, I threw this in here to kind of mess you up. We don't care about the interest because we're just interested in recording the initial transaction, but there's a couple things going on here. So let's kind of go through and break this down, right? So coming over here, I am buying equipment, right? So over here, we'll call this vendor. We don't know who it is, but they're going to be giving us equipment. Right. And so we're getting equipment of $90,000. Equipment is an asset unless it's a 7 Series BMW. I'm just kidding. No, I'm not. But right over here, it's actually a really good thing for a fast speed chase. Good stuff. High speed chase, but you don't want to do that. Maybe you do. I don't know. We purchase equipment for 90,000, right? So I'm receiving equipment. So right over here, I'm receiving equipment, and we want to label these transactions so we're not effed. No, we're just kidding. Oh, it's just the letter F. Okay, so we're coming over here. By the way, this is my opinion, my humor. It's absolutely terrible. All right. So enough with the dirty dad jokes. Let's keep on going. So I'm receiving equipment, right? This is an asset. It's giving us future economic benefit. Now, so I'm receiving the equipment. Now, how am I paying for this? Well, I'm not paying for this all in cash. Rather, 25,000 is going down in cash. So my cash is going out by 25,000. However, What's my problem so far? I have 90,000 in debits and I have 25,000 in credits. And so my transaction is out of balance. So what I need to do to balance is it says the rest will be placed on a note payable for 65,000. Now, how did I get the 65? Well, the equipment was purchased for 90. I'm giving a $25,000 down payment. So the note payable is going to be for the difference, or 65,000, right? We got to use high level calculus in these problems. Big deal, big bucks, no whammy. Really, really important. We got to use that math 3A from IVC, that math 3B, that math 4A. We got to use it. So over here, I'm going to credit note payable for 65,000. Okay. We are no longer F'd. We're good to go. So let's move away from F. Let's go to G. So when I come over here for the letter F, right, the other thing I want to also just share with you, if you're in my class, how could I make this more difficult? Well, instead of saying 25,000 down, I could say, well, what if you put 10% down, right? So you get the same equipment, but I just say 10%. So what you would do is you say, well, the cash is 10%, the remaining amount's on a note payable. So that's a variant of the question I could ask. Remember, the interest isn't of concern to us at this point in time, because that's going to be something we're going to deal with for problems from exam 2, because that deals with what we call adjusting entries, and we're not there yet. All we're doing right now is recording assets, liabilities, and equity, and we're going to feel comfortable with going through and recording these transactions. And we're going to be at the same time, we're doing the mega. Very important mega. We're going to make accounting great again. This is the mega that I like. There we go. Okay. I'm totally apolitical. I make fun of everybody. Let's go to the next one. Let's go to G. TRI purchases inventory to be resold in my retail store for 19,000 on account. So I'm receiving inventory, right? So right over here, let's go to our little chart. Basically have over here, we've got vendor is giving us inventory. And inventory is something which is an asset, right? How do I know it's an asset? Well, on Apple's balance sheet, it says inventories. Now, inventory is something we basically buy or we produce ourselves, and we are going through and reselling. So it's an asset. It gives us future economic benefit because we can turn around and sell it. So over here, I'm going to debit inventory for 19,000. This is letter G. Now, for every debit, I need a credit, right? But over here, what's really important are these two words, right? These are G words, not F words. These are G words, right? This says on account, right? So I come over here, right? I'm not paying cash, but rather this is going to be an account payable. Okay, so this is going to be accounts payable. It is a liability that needs to be repaid. And so over here, I'm going to have 19,000 from transaction G. Okay, so again, liability. Now, one of the things is we've just seen here, you might be saying to yourself, Bennett, what is a loan payable, note payable, and account payable? Okay. Give you some pretty easy guidelines. A loan payable is really when we're borrowing money straight out. That's what's happening here. Account payable is, and they're all liabilities, but there's slight differences. A loan payable is going to be something, or you might like term debt, be other different names for it. But I've borrowed money that I have to repay. For an account payable, I've purchased something like inventory that I'm going to resell on account, meaning I've gone to the vendor and I said, hey, will you give us terms? Meaning that will you allow us to, pay you back over time. And we see Apple here has 47 billion of accounts payable that they've got to repay. So when we look at basically, accounts payable, that's really what it is. Now, a note payable, if you look at the transaction from the letter F, this over here is usually going to be associated with equipment or what we call secured transactions. If the person borrows the money to buy the equipment and they don't repay, that note payable, whoever owns it can go after the person for non-payment and seize back the equipment. But for our purposes, if you're taking my class, if you're taking my exams, I'm going to be pretty clear as to whether it's a loan, note, or an account payable. The account payable, because it'll say on account. Note payable might just say note payable. And then you have up here the loan from Silicon Valley, the loan payable, right? So those are kind of there's three little differences there. So let's go to the next one. They're all liabilities, but we call them different things. I pay a consultant $82,000 for future services that the consultant is going to perform for us next month. Now, if you look at this is kind of the opposite of transaction E, right? This is what was, this is going to be the opposite of transaction C. Sorry about that. So let's say this again. I pay a consultant $82,000, right? So coming over here, and the amount that I'm paying them is I'm paying them $82,000. So the consultant, I'm giving them $82,000 cash, right? So for TRI, my cash is going down. So I'm going to come up here and I'm going to credit cash for 82,000. This is going to be letter H. So right over here, we've got 82,000 cash. Now, but what is this consultant going to give me? They're basically going to give us future services. And what we're going to call this in terms of the T account is this is going to be what we call prepaid consulting services. And that is exactly what this basically will be right over here. So this is going to be transaction H. This is an asset. They have to perform services for us. It's a future economic benefit. So we're going to show that as a debit. So my cash is going down when I pay for the services, but then they have to perform services for me in the future. Let's go to the last one. I lease building space from Sadhu Harry. Sounds like an FBI investigation. TRI gives TRI gives SHI $120,000 as a security deposit. The lease will cover the period from January 1st through December 31st, 2028. So I'm leasing space and I'm giving them $120,000. So let's write this out again. So over here, we've got SHI. And this is going to be for 120,000. So my cash is going down over here. And basically, this is a security deposit. And with security deposits, if I'm leasing a facility, the landlord may require me to put down a security deposit in case I decide to destroy the place. But I'm generally going to get that deposit back when I move out of the building. So over here, my cash is going down by 120,000, but for every credit, I need a debit. And I'm going to go ahead over here and debit security deposit, which is going to be an asset. So those are our transactions. I show an asset with an increase with a debit. Now, when you're taking accounting, this is really the key, is you want to practice. The more of these questions you go through and do, the better off you're going to be when you're learning accounting. That's really what it all comes down to. So the more you practice, the better off you're going to be. It's a skill. I realize with AI and ChatGPT and all this other kind of fun stuff, but as a business person, you need to kind of know how transactions are recorded. So it's important to learn. Okay, so let's go to the next phase. We've put these into T accounts, and now we've got to do a trial balance. What exactly is a trial balance? Well, I need to make sure that all of the debits I've entered equal all of the credits. So what I now need to go through and do is to basically total up all of these accounts. So when I do a trial balance, I'm basically going to be making sure that my total debits, or the D, equal my total credits, or the C. So what I need to do is I need to go to each one of my T accounts, and I need to go through and total them up. So let's go through and do that right now. So over here for cash, I have 734,000 in debits. How did I get that? Well, 500 plus 59 plus 175 allegedly equals 734. I have total credits over here of 303. So I received 734. I paid 303. To figure out my final balance, I subtract the smaller balance from the larger, and I leave the remainder on the larger side. So 734 minus 303 is equal to 431. For equipment, over here, 150 plus 90 is 240. Loan receivable, only one balance, 76. Prepaid consulting, 82. Security deposit, 120. Unearned revenue, 59 credit. Loan payable, 175 credit. Note payable, 65 credit. Account payable, 19 credit. And then common stocks, 650 credit. Just adding these two up. So when I do a trial balance, right, this is an internal thing we're doing just to make sure our total debits equal our total credits. When I do a trial balance, so I want to set it up in a very particular way. For this exercise, we're only focusing on the balance sheet, or assets equals liabilities plus owner's equity. So what I want to do is I want to list out all of my assets, followed by my liabilities, and then lastly, I'm going to have my owner's equity. Now, when I do this, right, I'm going to go ahead and paint this little thing. I'm going to say, okay, we're going to paint this little tree right here. God, wouldn't it be nice if we were doing Bob Ross instead of accounting, painting with T accounts? So right over here, I'm going to bring cash, and cash has a final. Well, we can do a little bit of painting with Bob right here with Bennett. Let's go over here and we're going to, oh yeah, look at that. Look at that little nice little bush right there. Oh, there we go. Beautiful. It's a 431,000. I'm going to come over here, bring over a little equipment right over. Oh, it's big equipment, 240. I mean, it's too wide of a brush stroke. And then I've got over here, I'm going to stop at loan receivable. Now, if you're taking my class, we can abbreviate. Okay. So over here, 76,000, inventory, 19,000, prepaid consulting services. It's going to be 82,000. And then we've got a security deposit of 120. And what we're just doing here is we've just listed out all of our assets, and I'll show you why we do that momentarily. Okay, so those are our assets. Now let's go ahead and look at our liabilities. So our first one here is we have unearned revenue, or UR. Now, when we list out assets and liabilities, when we in a few for the next exam, we're going to be very concerned with how we list them out. But for right now, we're just dumping them out underneath. So over here, we have loan payable, or LP. It's not a record, it's a loan. Over here, we have got the dad jokes are just streaming out. It's all that transaction F. I'm totally effed. Okay. Right over here, we've got note payable of 65. Then we're going to have AP, accounts payable, of 19. Wow, hold on. 19,000. Perfect. And then that is all of our liabilities. Now we're going to have over here our owner's equity. There's only one account, and that is going to be common stock. This has a credit balance, right? Remember, you have to put them on the correct side. Liabilities typically will have credit balances. Assets have debits. Now, the big reveal, right? This is like the final rose ceremony times 300. We come over here and we are adding up our total debits. So we have over here total debits of 968. And we have over here the final rows. Well, we're going to get to the final rows in a second, is 968. We're awesome. So our total debits equal our total credits, right? So that is our trial balance. All we're doing is to go through and check to see if our balance is correct. Now, the last thing we're going to prepare is an unclassified balance sheet. Does that mean it's top secret? No, it just means that we're going to list out. We don't care about the ordering. This here in Apple is a classified balance sheet. And what we're going to learn about in the future is that when we list out assets, we have to list them in the order of liquidity. And we have to separate them between current, meaning those that we're going to use in a year, and non-current, which is not going to be used in a year. But we don't care about that because all we're doing is learning how to make a balance sheet, build a snowman. So we're going to come right over here. And when we do a balance sheet, we're going to have TRI, balance sheet. We got to make sure we put a big label on this. We're a balance sheet. And we're going to say as of 12/31/26. All these transactions took place on 12/31/26. So right over here, we've got this part over here. Now, when we do a balance sheet, what is it going to look like? Well, it's going to look like this. We're going to show our assets, liabilities, owner's equity, but most importantly, we're going to show that it balances by showing the total liabilities and owner's equity. So I come over here, I have assets. Assets over here, I got cash, I've got equipment, I've got loan receivable, I've got inventory, and I've got prepaid consulting, and I've got a security deposit. So over here, my cash is 431, equipment 240, loan receivable 19, prepaid consulting. So my total assets are going to be $968,000. Now, when I prepare balance sheets for you watching this, you're going to see me indent things. And the reason why I do this is so you know that I'm adding numbers up. When you look at a traditional balance sheet, they may do more of like indentations. And you'll see double underlining and dollar signs. And oh my God, it's too fancy. But no, look, we're learning accounting. Whichever way you're going to go through and do it, at least for my class, this is how we're going to go through and learn. Then we're going to go over here to liabilities. And notice what you don't see. When I do a balance sheet, I don't say debit or credit, right? When we look at a balance sheet, there's no debit or credit. Rather, we're just going through and listing out everything. So for my liabilities right over here, right, I'm going to basically have unearned revenue, loan payable, note payable, and account payable. Wow, that's like the whole kitchen sink. 59, 175, 65, and 19. So my total liabilities are going to be 318. My owner's equity is just going to be my common stock. Call that C/S. So this is going to be 650. My total owner's equity is going to be 650. Now, here's the big kicker. We've got a problem. We not balanced, but what did we forget? We forgot to say total liabilities and owner's equity. And my total liabilities and owner's equity, this is going to be 968,000. So there I have done the balance sheet. My total assets equal my liabilities plus my owner's equity. So that basically takes us to the end of this video. I want to thank you for liking and subscribing. It always helps the channel. right? Please leave any questions you might go through and have below. I look forward to seeing you on future videos, and have a great day and enjoy your learning of accounting. Remember, you want to start with the basics and work up from there. Have a great day.